So what is a strip bond? A strip bond is a debt instrument in which both the principal and the regular coupon payments have been removed or sold separately. And they also call this a zero coupon bond. So, basically a traditional bond, you have the bond and then you have like a yield that it pays you. So let's say you buy a bond for $100 and it has a 5% coupon and it expires in a year. That means you'll make $105. So you'll make, like if it's a 5%, you'll make $105 upon maturity. Now, how a strip bond works is a little different. So basically on the maturity date, the investor is repaid an equal amount to the face value of the bond. The difference between the purchase price of the bond and the face value at maturity represents the investor's return on the bond.
Yeah, to kind of go back to the top real quick. So, when you have a normal bond, obviously you have a principal, then you have interest. And when you're buying that, you're buying both of those within the same security. When you strip a bond, you effectively turn that principal side into a zero coupon bond, which allows you to buy it at a discount to whatever the face value is. And upon maturity, you can redeem that at par, meaning it'd be a 1-to-1 redemption. So if you can buy the bond at a 15% discount, for example, and so let's just say 85 cents, just easy numbers. If you buy it at 85 cents on the dollar, by the time that bond matures, it will be equal to that $1 face value of the actual bond. And so that's how you make your profit on the principal side of a strip bond. Now, on the coupon side, so normally the yield for that asset is tied to like within the asset, the value is within the asset. So by taking or stripping the bond, you basically extract the value of the yield. And so the yield becomes a separate instrument within itself, and it has value within itself. And so investors can buy the yield and they can be long that yield. They have different strategies for it, but they can buy the yield and profit from that yield going up. So that's like the general overview with like some detail on bonds and strip bonds. And now that would probably be a good segue for what Pendle is actually.
Yeah. Quick thing before we talk about what Pendle is. The main difference between Pendle and traditional bond stripping is that Pendle is a decentralized protocol. So bond stripping is a super centralized process. You have to go through these brokers. You have to talk to a lot of different institutions. So Pendle makes it more secure, more cost efficient, more time efficient because you don't have to waste time going through all these brokers and relying on old settlement methods. And it also makes it more transparent. And then the revolutionary thing that they're doing is that in the traditional bond stripping world or industry, you can only speculate on the current yield. Now, Pendle Finance is allowing you to speculate on future yields. So they're not only bringing a $4 trillion market to Web3, but they're also adding a new component that will give institutional investors another means to generate returns, because most of the returns, or not most of the returns, most of the smart money is in the bond market, because it's a place where you can go to buy something like US Treasuries, which is out of anything you can get a yield on, you're most likely going to get your yield paid back on that because it's basically coming from the Federal Reserve or the US government. Why go take risk buying a stock that can go down or buying real estate when it can go down? Not to say that these aren't good investments, but the bond market is where most of the money is because you can get fixed yield on things. And now Pendle is allowing you to be able to speculate not just on current yield, but future yield.